Hello everyone, in this video I will be covering the topics on bonds. After this video, don't forget to do the quiz form on Connect system. So first I will finish the last several slides that we didn't get to finish last Friday. Those are the topics on the bond features. And then we're going to move on to the valuation of bonds. So just in case some of you were not there in the last class, I'll also show you the full version of the slides that we did cover. So this is where we left off last time. So the next feature about bond concerns how the issuers pay back the par value. So for the term bond, the bond has one single maturity date. That means the firm pays back the par value in one single cash flow. Whereas the serial bond is a bond that has a series of different maturities. So they will pay back the par value in several cash flows. So a bond typically starts to retire their bond beginning in the 1 to 5 years after the date of issue, and they continue to make the payment until all the par value is paid off. Okay, so any amount that is not paid before maturity will be paid on the maturity date. Okay, so for example, if the firm has a par value of 1,000 and they choose to pay back $100 in each year in the first 5 years, and if the maturity is 5 years, then by the end of the 5th year they will pay another $500. Okay. The next feature about a bond is whether the bond is collateralized or not. Okay, one of the biggest concern for a bondholder is what if the issuer goes default. Okay, in other words, they don't make the payment back. Okay, in order to protect themselves against this default risk, one thing they typically do is to take some assets as collateral. In the worst case scenario that the issuer goes default, they still have claims to those assets, and hopefully they can sell those assets to recover some of their loss. A bond can either be collateralized or not. Okay, if a bond is collateralized, it's called a senior bond, and if it's not, it's called junior bond. The junior bond would purely depend on the reputation or the credibility of the issuer. The most commonly or the most popular unsecured debt is called debenture. Okay, now for debenture, there are two types of debenture depending on the agreement between the debt issuer and the debt holder. They're classified into unsubordinated debenture and subordinated debenture. The difference between those two is that the unsubordinated debenture has priority over subordinated debenture in terms of claiming for income or claiming for assets. Okay, so in other words, when the firm has income, they have to pay the coupon to or the par value for all three types of debt holders. They would first pay the secured debt and then pay the unsubordinated debenture and subordinated debenture. Okay, and the same thing goes for when the firm goes default and they have to distribute those assets back to those debt holders. Okay, so the secured debt holders gets paid first, and then so on and so forth. Okay, now the question is, why would anybody ever want to purchase a subordinated debenture since it's so risky? The answer, of course, lies in the risk and return trade-off. So if you compare all those three debt holders, obviously the secured debt holders, they have the safest assets and the return they have would be the lowest. But the subordinated debenture, they would have the highest risk but also the highest return. As we've said, the biggest risk that a bondholder is facing is the default risk. Okay, so before you purchase any bond, you want to figure out what is the default probability for the issuer. The higher the default probability, the higher return you would rationally want to get from this debt, right? Otherwise, you won't invest in it. Now, how do we figure out what is the default probability? Obviously, you can rely on your own judgment, but oftentimes investors rely heavily on the bond ratings. Okay, bond ratings are evaluations of the default probability that are made by major rating agencies. Those rating agencies include Moody's, S&P, and Fitch. Okay, what they do is they analyze the firm's financial statement and analyze their future prospects in profiting, and they come up with some models to estimate the default probability. Okay, so the market actually relies heavily on those bond rating. Okay, now one of the potential drawback is that those rating agencies could be wrong, right? So when things could go very smoothly when those rating agencies are fair and smart in making their judgment, but when they make mistakes, things could go very wrong. Okay, one of the criticism from the regulator is that those rating agencies are actually part of the cause for the financial crisis. Back in 2008. We know that the financial crisis was caused by the submortgage crisis, right? So back in 2008, a lot of the financial products that are based on those submortgages were actually rated very highly by those rating agencies. Okay, so investors trusted their judgment, so they invested heavily on those safe, according to their rating agencies, on those safe assets. Okay, but later it turned out that those are all bad debt. Okay, so the default rate was very high. So those investors lost a lot of money, and subsequently, those loss caused this financial crisis. Okay, so they can go wrong. Okay, actually recently, the SEC again charged the S&P for some misconduct in their rating. Okay, so as an investor, we should be very cautious about things. Don't put too much trust on those rating agencies. This table shows you the possible ratings from two rating agencies, Moody's and Standard & Poor's. For Moody's, the ratings goes from AAA to C, and S&P goes from AAA to D. So for the higher the rating, the safer the asset. Okay, so anything that's below equals or below the BB rating is considered non-investment grade. So those assets are typically called junk bond. Of course, when the AAA debt holders wants to issue a debt, investors will be willing to accept a very low coupon. So our treasury bond, our treasury bills are typically considered AAA issuance. Okay, because it's backed by the government, so it's very safe asset. For those junk bonds, they have to provide a very high return for investors to give them money. Okay. So those ratings will directly affect the cost that the debt issuers has to pay in order to get money. Now let's move on to the bond valuation part. The learning objective for this video is that first, you'll be able to price a bond. And secondly, you need to be very familiar with the basic relationships in bond valuation. We'll talk about this towards the very end of this video. The idea of bond valuation is very similar to stock valuation. So given any bond, you want to find out what is the fair value of this bond to you. In other words, how much is it worth in your mind? So the basic principle is that because bonds, like stocks, bonds represent some future cash flows. Therefore, the value of a bond should equal to the present value of the expected future cash flows, given a certain discount rate that you want to use. According to this principle, there are three steps. So the first one is to determine the cash flows. So there are two sources of the bond cash flows, as we've discussed in the lecture. There are the coupon payment and also the par value that's going to be paid at the maturity date. Those are the things that we can easily find from the statement of the question, or in reality from the bond contract. The second step is to determine the appropriate discount rate. Okay, so the discount rate is really what the return that you want as an investor. Okay, so obviously we all want a return that is as high as possible, right? But that's not realistic. Okay, in reality, the appropriate discount rate is determined by the risk of the bond. The higher the risk, the higher the return we should expect, because we're taking risk. Now, that's why in reality, when we try to find the appropriate discount rate, what we often do is to take a look at the prevailing market yield. Okay, that is what other bonds that are of similar risk is provided in the market. Okay, so there are generally two ways to looking for a market prevailing yield. One is to observe what other bonds that's of similar risk is providing. Okay, so let's say you are trying to value the bond by AT&T. Maybe you can look at what Verizon is currently offer. Okay, what return Verizon is offer. So you can find that by, if you observe the price and the future cash flows, you can find out what's the implied return from this bond. Okay, so we'll learn that part in the next part of the this bond topics. The second way is to look for some market data. And many companies are compiling the data on bond yield. Okay. Oh, by the way, so in the bond market, we often refer to return as yield. Okay, so yield equals to return. Now, from those market data, you can find the yield for bonds with different ratings. The ratings indicate the risk of the bond, right? The higher the rating indicates a safer bond, and they're gonna have a lower yield. Okay, so those are the data that you can find on those websites. Now, for the bond that you are trying to value, if they have a rating from the rating agency, you simply take that rating to those data and look at what they are offering. Okay, I'll show you in a second. So once we determined the appropriate discount rate, the third step becomes very intuitive. We have those cash flows, and then we have the par value, and we can discount it using the appropriate discount rate to find the present value. Okay, so if we write it in the formula, this is how we do it, right? That's the present value of the first coupon payment, present value of the second coupon payment, and so on and so forth, and also the present value of the par value. Those are the notation. Okay. So here's an example. Suppose on January 1st, 2013, AT&T issued a bond with a maturity date of December 31st, 2032. So that means there are 20 years into maturity. Okay, and the coupon rate is 8.5%, indicating that every year you're gonna receive $85. Okay, and the interest is paid every year. Par value is 1,000. That's what you're gonna receive by the end of 2032. And the market yield for a similar bond, similar debt is 7.5% per year. Okay, so because they're of similar risk, so we should use this as an appropriate discount rate. Okay, so now the question is, what's the value of the bond? So there are two ways to do this. One way is to use the formula. Okay, so here are our the timeline for the cash flows. Okay, so we receive $85 each year for 20 years, and in the last year we receive $85. That's the coupon payment plus the par value, which is 1,000. Okay. So there are two ways to us to find the present value. One is to use the formula. Okay, present value of the first one, second one, and so on and so forth. Last one, the cash flow is $1,085. So the price should be $1,101.94. Okay, and the second way is to use financial calculator. Okay, as we can see, this is close to an annuity, except for that the last one is 85 plus 1,000. So this 1,000 would be the additional cash flow on this annuity, right? Taking it as a whole, this is a complex cash flow, but we can view it as ordinary annuity plus 1,000 additional cash flow. Okay, so we can put N as 20. Because there are 20 payments, the discount rate I over Y is 7.5, and this 85 is the coupon payment. Okay, so that is the payment in the ordinary annuity, and the future value FV, the additional cash flow, is 1,000, and then we compute PV. Okay. Now, one thing to really remember is that the coupon rate and the discount rate, there are two different things. Okay, the coupon rate only determines the cash flows. Okay, but the yield or the discount rate is the return that you want. That's the discount rate. Okay. In the second example, suppose in the previous example, the coupon is paid semi-annually. Now, what should be the value of this bond? Now, if it's paid semi-annually, of course, it's going to change the discount rate and also change the cash flows, right? So here's how our cash flows look like. Now, instead of having 20 periods, we have 40 periods because we receive cash flow every half year. Okay, so every half year we receive a half of the coupon, which is 85 divided by 2. So that's 42.5. And by the end of the 20th year or the 40th period, we receive 1,000 plus this 42.5. Okay. So again, there are two ways for calculating this. If we use formula, this is the expression. Okay, so the present value of the first one, second one, and goes on to the last one. Okay, so here I'm writing the last part into the last cash flow into two parts. Okay, but you can combine them together. To use financial calculator, the N will now be 40 because we have 40 payments, and I over Y is the discount rate. So every year the discount rate is 7.5, so every half year it's 3.75, and the payment is 42.5. FV additional cash flow is 1,000. Okay, so the value now should be $1,102.75. Okay. The next example, the pricing of a zero coupon bond. Now, as the name has indicated, the zero coupon bond are the bonds that have no coupon. Okay, that means their coupon rate is 0%. Okay, so you may wonder, how do investors make money if it's a zero coupon bond? Remember, there are two sources of the profit for a bond investor. You have the capital gain, capital loss that comes from the price changes. The second part is from the coupon portion, right? So now the coupon portion is 0, so your return will simply comes from the capital gain, capital loss part, right? So if I pay 200 today to buy a zero coupon bond that will pay me $1,000 in 10 years, then my profit will be the $8,800, right? So there's no coupon. So this could happen. Now, suppose you purchased a 15-year zero coupon bond today, and the par value is 1,000. Okay, and the market prevailing yield for a similar bond is 8%. What is the value of this bond? So here's how our cash flows look like. There's no coupon payment. Okay, so the only thing you're expecting is this $1,000. Okay, so to find the value using formula, you use $1,000 divided by 1 plus 8% to the power of 15. So you're discounting it for 15 years. So the price is very low right now. Okay, right? So $315. To use a financial calculator, it's very simple because now it's like a present value of a single cash flow. N is 15. I over Y is the discount rate, is 8. Okay. Again, this is different from the coupon rate. Coupon rate is 0%. It only tells you the cash flows. Okay, so I over Y is 8. Okay, that's the return you want. FV is 1,000 and PV is 350. Now that we have learned how to price a bond, let's look at some of the basic relationships in a bond valuation. I'd love you guys to pause for a moment and to finish this table first. Okay, so in this table, you need to find the value of a bond that has a $1,000 par value, and I give you a lot of different scenarios. So for example, in this scenario, there are 5 years until maturity, and the market prevailing yield is 15%. Okay, so you need to find the value here, and in this cell, you need to find the value of a bond that has par value of 1,000, maturity of 0 years, and market prevailing yield is 9%. Okay, so finish this table first. So here's the answer to the table. I just want to quickly show you how to calculate several numbers. For the first one, in this cell, the N will equal to 5, because 5 years into maturity. I over Y will equal to 15. That's the market prevailing yield. Everybody else is paying this. Payment is gonna be 120. Okay, and FV, additional cash flow, is 1,000. Okay, and then you compute PV. Now, for this number, N will be 0. I over Y is 9. Payment is still 120, and PFV is 1,000. Okay. For this number, N is 3. I over Y is 9. Payment and PV will still stay the same. Okay. Now, for all of those examples, you simply compute FV. Okay. Now, there are several interesting relationships that we can discover from this table. If we compare each column, so let's say those 3 numbers, we can see that as the market prevailing yield goes from 15% to 9%, it goes down. The price actually goes from 900 to about 1,100, right? So that means the market prevailing yield and the value of a bond is inversely related. Okay, and conversely, when the market prevailing yield goes up from 9% to 15%, the price will go down. Okay, so why is it the case? Because again, the market prevailing yield is the discount rate, right? So when the yield goes up, the discount rate will go up. Okay, so the more you discount it, the less the price. Okay, so this is what we refer to as interest rate risk. Okay, this is something as a bond investor you should be especially cautious about. Okay, so if you're the bond investor, when the let's say the Fed announced that they're gonna increase the interest rate, you know that the value of your bond will go down. Okay, so you will suffer from a loss. For example, yesterday the market prevailing yield is 9%, so the value of your bond will be this much. So if you want to sell it, you can sell it at this price because everybody else will think it's worth this much. Now, if tomorrow the Fed announced an increase in the base interest rate, so everybody will suddenly pay more, then you know that when you try to sell the bond, the price will go down to 900. So as a bondholder, you will suffer from a loss. Okay. But luckily, when the yield goes down, the value of your bond will increase. Okay. And the second relationship, we can see that by comparing each row. Okay, so from the first row, we can see that when the market prevailing yield is bigger than the coupon rate, which is 12%, the value of the bond is gonna be smaller than the par value. Okay, so at this time, the bond will be called a discount bond. Okay, so this is always the case. Okay, what is the intuition behind it? So suppose you're a bondholder. When your coupon rate is 12%, but everybody else is receiving 15%, you also want a 15% return, right? But you're from the coupon portion, you're not compensated enough. You're receiving 12%. So you want some additional return from the capital gain and capital loss part. Okay, how do you get the capital gain? By paying less than the par value, right? So if you pay 899 now and you receive 1,000 later, you have some capital gain. Okay? That compensates for the 3% discount, the 3% difference, right? So if we look at the second row, okay, when the coupon rate equals to the market prevailing yield, the bond price will equal to the par value. Okay, so we say that the bond is traded at a par value at this case. Okay, why? Because again, it's the same intuition. Investors want a 12% return, and they are getting 12% coupon rate. So their return is they're fully compensated from the coupon portion. Therefore, they don't need to have any capital gain and capital loss. Okay, so that's why the par value will equal to the price. So they have no capital gain or loss. And thirdly, if we look at the third row, when the market prevailing yield is smaller than 12%, so that means your coupon rate is higher than what everybody else is getting, than your discount rate. At this time, the price will be higher than the par value. That means you suffer from a capital loss. Okay, so the intuition is very similar. As a bondholder, you want 9% return, but your coupon rate is already 12%, so you are more than compensated in the coupon portion. So that's why you're even willing to sacrifice to get a capital loss on the capital loss and capital gain part. How to get a loss? By paying more than the par value, right? So if you pay $1,100 here and you receive $1,000 later as the par value, then you have a capital loss of $116. Okay, so but you're fine, right? Because you're way more compensated in the coupon portion. Okay, and lastly, in the last row, I calculate the price changes when the yield changed from 9% to 12%. Okay, so how do we get this first number? We use the 899 minus the $1,116 and then divided by this 899. Okay, so the price change will be negative 19%, and we calculate this number for each row. Okay, so one thing we can see that's pretty interesting is that for the longer period bond, for the bond with different maturities, when the yield goes up, when the market prevailing yield goes up, the price of those bonds all go down. Okay, so that's what we refer to as the interest rate risk, right? But the long-term bonds are the ones that suffers from the largest price changes. Okay, so that's why we say the long-term bonds have greater interest rate risk than the short-term bonds. Okay, now what is the intuition? Here it is. When the yield goes up, now all the bondholders suffer from a loss. Okay, but the long-term bondholders, they will be receiving lower than market prevailing yield coupon for 5 years, right? So they're receiving 12%, but everybody else is getting 15% now, right? So they suffer from a loss, but they suffer from a loss for 5 years. But for those guys, with yield to maturity of 1 year, they only suffer from a loss for 1 year. By the end of the 1 year, they can replace this low yield bond with another. This one will mature and they can buy another bond that pays 15%, right? So they only have a loss for 1 year. That's why these guys have a bigger loss, okay, on the coupon portion. Now, how to compensate for their larger loss in the coupon portion? By having a larger capital gain. Okay, so that's why the price will decrease by a larger percentage. After this video, don't forget to do quiz 4 on Connect. Okay, so in the quizzes, they actually refer to the market prevailing yield as yield to maturity. Okay, so just use that as the discount rate. Okay, I will see you in class.